this YouTube channel. Today is Tuesday, the 16th of May, 2023. All right, and this is today's agenda. We're going to talk about a lot of interesting topics today. Of course, we will start off as always with the summary of the trading day. We will take a look at some notable upward movers today. We will take a look at how the US indexes performed, and also, of course, we will take a look at the treasury yields in the US. Then we will move on to our first special topic, which is the debt ceiling debate. We will talk about the fact that US executives are urging the Biden administration and Congress to, quote, get it done. And we will also talk about the Biden and McCarthy meeting that we saw today. Now that we will move on to some macroeconomic data. We got retail sales today, very interesting report. And we got some more comments from Fed officials, which we will analyze. Moving on to the regional bank sector, we heard some good news from Western Alliance Bank today. Shares of Western Alliance are up. And we will also take a look at the chart of the day, which is basically retail sales adjusted for inflation. Very interesting chart. Today is the first time I actually saw this chart, and it says a lot about the underlying strength of the consumer. All right, let's take a look at how the major US indices performed. The S&P 500 finished the trading day in the red with around negative 0.6% at 4,109.9. Dow Jones Industrial Average also in the red by around 1% and decreased to 33,012.14. The NASDAQ 100, the only major US index that is up today, finished in the green with 0.09% at 13,426.01. Now, the NASDAQ 100, what we have seen is tech stocks, mega cap US tech stocks significantly outperform also within the S&P 500, which just signals that US investors are trying to run to safety because of all the uncertainty that is out there at the moment. Now, moving on to our notable gainers of today. Let us start off by talking about advanced micro devices, up today by 4.19% at 101.48. Well, what is going on with the stock? Basically, Bernstein analyst Stacy Rayson issued a note on AMD in which she said that the PC market is now normalizing at the levels of 2019 after the massive decline we have seen after the pandemic boom, and that is boosting the stock today. This note from the analyst. Moving on to Alphabet shares, up today by 2.57% at 119.51. The reason for these upward movements within the Alphabet shares is basically there were fears that ChatGPT could be incorporated into the Bing search engine, which would pose a great competition to Google if that would actually happen. But it seems like as of now, those fears have faded away also within hedge fund managers. So the stocks are up, the shares are up today by 2.57%. Amazon, another notable mover, up today by 1.98%. US Treasury yields up across the curve at the short end, at the long end, at the belly of the curve. The two-year Treasury yield now exceeding 4%. We continue to see that volatility at the short end of the curve, especially at the very short end. If you look at T-bills that are maturing at around the X date, we're seeing a lot of volatility and upward movement in yields within those as we approach the X date because of the current debt ceiling fears in markets, which have been kind of contained, which is why we're only seeing those significant movements at the very short end of the curve. But in general, yields are up today, also because of the retail sales report. Definitely, given the strong consumer, given the hawkish Fed, I would recommend staying away from the long end of the curve, because that curve could very likely steepen again due to the current economic data and a hawkish Fed. Now, moving on to the debt ceiling debate, let us take a look at what the industry is actually telling us. Now, we are seeing financial firms such as JP Morgan, Bank of America, Citigroup. These financial firms are incurring expenses to study how the government's failure to pay bills would affect markets, according to Bloomberg. Now, what these financial institutions basically said is that damage to US businesses and the economy could actually start before the technical default. We are already seeing US funding costs rise. Like I said, T-bills are significantly, the yields on T-bills maturing around the exit are significantly increasing at the moment, which of course means that there are higher funding costs. But like I said, not significant movements within the other treasury yields, which of course the problem with the T-bills is that they mature so soon, right? Which is a problem if you see significant increase in those yields. Rob Toomey, he is the head of capital markets at the Securities Industry and Financial Market Association. He said today about this topic to Bloomberg that, quote, "We want to make sure market participants have a collective sense of how the system, the pipes that make things function, will work in the event of a breaching of the debt ceiling." He continued to add that it's never happened, so we don't know what degree the markets will be impacted, end of quote. Now, JP Morgan is also investing some resources to actually prepare for a potential technical default. And he said today that those preparations are like a, quote, war room. Some other interesting comments are coming from the group of current and former members of the Treasury Borrowing Advisory Committee. They said in a note today that, quote, "The magnitude of adverse consequences from a prolonged negotiation or a default is unquantifiable," end of quote. Now, kind of some background information. On Monday, Kevin McCarthy reiterated the fact that they are, quote, nowhere near reaching a conclusion. But if you look at stocks, if you look at equities, they remain relatively stable because investors, they know that such a scenario, it would be so devastating. A technical default would be so devastating that it will actually never happen. Now, Citigroup CEO said today that, quote, "The last thing that the world and America needs is to have a debt ceiling crisis." Let's kind of now get to the political side of this issue. Biden and Kevin McCarthy had a meeting today. Not that many new insights, but it was actually optimistic because both parties kind of reiterated the fact that a technical default is not an option. So they're really, really working hard to avoid this, and they will reach a conclusion. That is what they basically said, even though they did not give us one yet, but that was not expected at the meeting either. Now, let's look at some quotes from Kevin McCarthy, some things he said during today's press conference. He said that, quote, "No progress has been made, but we could be reaching an agreement by the end of this week." So pessimism and optimism here in one sentence. He also said that we got a lot of work to do in a very short period of time, and we can raise the debt ceiling if we limit what we are going to spend in the future. It is basically written in stone, right? You are going to see some spending cuts. The question is, where are you going to see those cuts, and to what extent? How many cuts will actually Joe Biden agree to? Now, another interesting story coming from this topic today is Biden actually has announced that he will shorten his trip to Asia to continue those debt ceiling debates. Could be a sign of optimism, right? Meaning that he is making some progress, so he wants to get back quickly. It could also be a sign of some pessimism here about this topic, because maybe it means that like even harder negotiation is required. We don't know. What we do know is that both Democrats and Republicans, even though it did not come from Kevin McCarthy himself, both parties are reiterating that a technical default is not an option because the impacts would simply be too devastating. All right, let us get to some more macroeconomics. We got a very interesting retail sales report today. Let us just kind of quickly dive into the numbers here. Headline retail sales number plus 0.4% in April. Core sales up by 0.7%. Manufacturing production rebounds to plus 1%. The home builder sentiment rises to a 10-month high. Now, what this data is telling us is that consumers are still spending more money at restaurants and bars. They're spending more at online retailers. And the spending is basically underpinned by strong wage gains and a tight labor market. Now, chief U.S. economist at Citigroup in New York, Andrew Hollenhorst, has said something very interesting about this topic to Bloomberg today. He said that, quote, "Today's report should help reassure markets that consumer spending is not about to contract and will instead support at least modest continued economic growth," end of quote. Let us dive a little more deeply into those numbers. Like I said, the overall retail sales number showing an increase of 0.4%. Which is a missing economists' expectations. Economists expected a 0.8% increase. But if you look back at the previous month, if you look at March, retail sales dropped by 0.7% in that week. So definitely some upward movements there on a month-to-month basis. Now, what is very important about this report is sales at food services and drinking places. This is the only service component of retail sales. And the spending at food services, kind of spending on going out for dinner and things like that, spending on things like that rose by 0.6%. Now, this is very important because economists view dining out as a core indicator for the strength of consumer finances. So if we continue to see strength, if we continue to see an increase in spending in that service component of retail sales, this is an indication that we continue to see a strong consumer, which will ultimately mean that the Federal Reserve might have to do some more tightening here or keep rates at a higher level for longer in order to get inflation back to the 2% target. However, I must mention here, spending on hobbies decreased 3.3% and furniture store sales fell by 0.7%, which does indicate that consumers are cutting spending on some discretionary items. Very interesting chart here on the right, a graph from Reuters. Basically, the green line is US core retail sales, and then you see GDP growth. Now, this graph shows us that core retail sales is a good preceding indicator of GDP growth, right? You can see right here, an increasing retail sales number means basically that you're going to have a positive or a very positive GDP growth number during that quarter. You can see right here, retail sales were dropping before the report, and then we actually see GDP coming in much lower than in the previous quarter. I'm not sure. I don't think these are quarters, but it is definitely some. Those are definitely GDP. Yeah, exactly. It looks at. Sorry, I kind of explained this the wrong way. It looks at personal expenditures, the contribution of personal expenditures to GDP. And what you can see here that the core retail sales contribution to personal expenditures is very large. Very interesting data. So this basically means that if we continue to see the core retail sales number at such a high level, because this is such a large part of GDP, we're going to see a positive print on GDP, which basically means, like I said, continued pressure on inflation and a Federal Reserve that will most likely remain hawkish based on this data. All right, let us get to some Federal Reserve comments from today. Richmond Federal Reserve President Barkin. Let me get to my notes because I don't have everything on the slides and not everything in my head. Now, he basically said today that we need sufficient evidence that inflation is indeed on a downward trajectory. And I said this many times. This is a comment that actually came from many Federal Reserve officials before the Fed actually starts to cut rates or before the Fed starts to even consider cutting rates. They need to be sure that inflation is on a sustainable downward trajectory. It remains questionable to me and to many economists how inflation is supposed to be on a sustainable downward trajectory if you still have such a resilient consumer, such a tight labor market, right? So I believe the Federal Reserve will not have that evidence until we see some slack in the labor market. Essentially, the Fed doesn't quit before the labor market quits, except if we see some deterioration in financial stability. So if evidence is missing, Richmond Fed chief said that he is willing to actually increase interest rates again. So in the past, we only talked about the fact that the Fed will pause now in the next meeting, but the general trend, because we got a lot of comments from Fed officials throughout the week already, most of them said further rate hikes are still on the table because we don't have evidence that inflation is indeed on a sustainable downward trajectory. So there's going to be a lot of data released. He reiterated on that fact as well. There's going to be a lot of data released until the next FOMC meeting, and he will base his decision on that data. Now, two more interesting quotes coming from him today. Very, very important to mention. He said that I do want to learn more about what's happening with all these lagging effects of monetary policy, but I also want to reduce inflation. And if more increases are what's necessary to do, then I'm comfortable doing that. He also said that there is a plausible story that we get inflation down due to a lot of the actions that we have already taken in the past, both ours and by others, but I'm still looking to be convinced on that story, and it may take more. So to summarize his view, not sufficient evidence that inflation is going to fall back to 2%. So he will most likely be more on the hawkish side of the Federal Reserve. Now, in a nutshell, two more Fed officials that held interviews today. Cleveland Fed President Mester said she actually repeated the importance of getting inflation back to the 2% target. She's also, I don't know, relatively hawkish Fed official said in a meeting a couple of weeks ago that the Fed remains data dependent and they don't have, like I said, enough information, enough evidence that inflation is indeed coming down and will continue to come down. Goolsbee, he's the president of the Chicago Fed, and he said that the effect of the previous interest rate hikes is still in the pipeline. That brings me to the beautiful table here. Now, I've created this table, and it kind of shows you, it kind of summarizes the recent comments coming from Federal Reserve officials. And down here, you can see a scale of hawkishness that I created. You can see it goes from 1 to 10, 1 indicating a very dovish Fed official, which means that Fed official that wants to cut rates today. Let's just put it that way, the extreme case, the impossible case, but the extreme case as an example here. And 10, very hawkish. I want to raise rates by another 50 basis points or something like that. Now, Neel Kashkari, he had an interview yesterday. He said that we have more work to do. The labor market is hot, and we have a long way to go before we get inflation back down. Raphael Bostic over here, the Fed president of the Atlanta Fed, he said something very similar. He mentioned the tight labor market, the resilient consumer, which both together will continue to put upward pressure on inflation. Inflation is still too high. We have a long distance to go. Now, I believe these two Fed officials, I give them an 8 out of 10 on the hawkishness scale because they both seem very hawkish. They both seem to even support further rate hikes. Of course, Raphael Bostic mentioned that he is more on the pausing side now, but simply saying that he's not thinking about rate cuts until 2024 indicates that he's a very hawkish Fed official that basically speaks against markets, which are already pricing in 3 rate cuts this year as early as June. Now, Austan Goolsbee, kind of on the neutral side, he did not really say anything about the further rate hikes or even a potential pause. He only said that we have yet to feel the full impact of previous hikes. And obviously, you need to add to that the tightening of credit conditions, which are also part of the Jay Powell arithmetic. And he said that we should be extra mindful and assess the data. So reiterating that the Fed is data dependent and, well, relatively neutral. We have to keep assessing the data. Touching upon the Jay Powell arithmetic. Now, Jay Powell basically, he has a certain understanding of getting rates to a sufficiently restrictive level. What he does is he takes the nominal rate, he subtracts 3% inflation to arrive at a real rate of 2%. And what you need to add to that 2% real interest rate, you need to add to that the effect of credit tightening. You need to add to that the effect of QT. So credit tightening, it is hard to put a numerical value to this effect, but we do know in what direction it is moving. So it's definitely increasing the real rate in the eyes of Fed President Jay Powell, and it does make a lot of sense. What you must remember with this Fed arithmetic, I don't really want to get into this now, but we have seen a significant increase in inflation expectations. And if you look at the Fisher equation, which states that the real rate is the nominal rate minus the expected inflation rate, you really need to remember, if you have a higher expected inflation rate, you will actually have a lower real interest rate, right? Which means that conditions are less restrictive if you have high inflation expectations, which intuitively makes a lot of sense because high inflation expectations mean you will continue to see wage growth. Consumers will spend their money now, right? All of that putting upward pressure on inflation. So it is very important for the Fed to keep those inflation expectations anchored. Now, Tom Barkin, we have already talked to him in great detail today. He is not convinced that inflation is on a sustainable downward trajectory, but he did reiterate the fact that he needs to keep assessing the data, simply saying that the Fed is data dependent. Now, what he did say is, and this is why I gave him a score of 7 here, not very hawkish, but simply hawkish. He did say that it could be a plausible story that we could get inflation down with the current measures, with the measures that we have already taken, but there is no proof for that yet. If you look at the resilient consumer, if you look at the resilient labor market, and the fact that core CPI still remains very sticky. Feel free to take a look at this table. Some more very interesting if you consider the current comments from Fed officials. Of course, we will also get some more comments this week, but overall, I would definitely say we're dealing with a hawkish Fed here that is going to keep pushing against market expectations of rate cuts this year. We're dealing with a Fed that will cause the yield curve to essentially steepen again at the long end, so kind of in the 30-year range. So I would definitely stay away from investing in 30-year treasury bonds. All right, let's get to the regional banks. Western Alliance, very interesting report today coming from Western Alliance, kind of bringing some confidence back to the regional banking sector. Oh, I never have an order here. I always mix up my notes. Okay, Western Alliance said today that deposits have stabilized by March 20. And since then, they have actually continued to grow. So we're not only seeing an increase in deposits, we are seeing an increase in deposits, but they're not only stabilizing, they're actually increasing. Now, as of May 12th, very interesting data here, 79% of deposits were insured. At the end of March, that value was at 68%. So it is not only that we're seeing an increase in deposits, we're also seeing an increase in insured deposits. A very good sign for the regional banking sector, a very good sign for Western Alliance Bank. All of us know in the past 2 weeks, Western Alliance, Pacific West, two regional banks that have come under significant pressure, not because the asset side or the liability side of their balance sheet is indicating a very problematic situation. No, both the liability side and the asset side of their balance sheets were actually in a relatively healthy position, right? For example, if you simply look at deposits, no significant no deposit flight at all, actually enough liquidity to cover uninsured deposits, a significantly smaller amount of uninsured deposits compared to SVB, compared to First Republic. But the fact that Western Alliance is reporting this data means that some confidence will be brought back to the regional banking sector, which is another signal for the Fed to keep rates at a higher level for longer after all, but definitely good news coming from the regional banking sector here overall. All right, last but not least, let us get to our chart of the day, US monthly retail sales. You see the nominal rate, you see the inflation adjusted rate. If you look from here, 2019 to around March 2021, maybe. Yeah. So you kind of see the nominal retail sales rate and the inflation adjusted rate kind of really, there's not a large spread between them because inflation is not so high during that period. But starting in March 2021, you see a significant spread between the nominal rate and the inflation adjusted retail sales number, not rate, but nominal retail sales number. So the fact that you are seeing the spread, you need to be careful. Maybe you cannot read too much into the nominal retail sales number. You actually need to take a look at the inflation adjusted number. So this, like I said, tells us two things. Maybe the consumer is not spending as much as the headline number is telling us, because actually the inflation adjusted rate is kind of stagnating. Second thing that this chart is telling us, even though we're not really seeing retail sales increase on an inflation adjusted basis, the retail sales number inflation adjusted is actually stagnating and it is not decreasing, which still indicates a resilient consumer. And that is it for today's closing bell update. I hope you enjoyed today's presentation and have a great evening.